Good evening, everyone, and welcome to the new MLA Productivity and Profitability webinar series. A very warm welcome to you this evening as we kick off this new series. It's great to have you on board tonight to kick off this new series, which has been broadened to cover topics on beef, lamb and goats, which is very exciting. My name is Hilary Beach and I work with the webinar coordinators Holmes Sackett. We'll be hosting 30 webinars from now until July 2020. These webinars will be recorded and can be accessed at a later date. They will be hosted on MLA's website. The exact location to be announced, but I will put that in the next email that goes out. So to get straight into it, the title of tonight's webinar is an update on lamb and beef benchmarks from the 1718 Holmes Sackett benchmarking data. We do have another webinar planned for later this month, and I'll advise on that by email once we have the relevant details. So this is the control panel that you will be seeing on probably the right hand side of your screen. This is your go-to for tonight. The red button or the red arrow to the left of the control panel collapses and reinstates this control panel for you to be able to see your screen a bit more clearly. You should be able to hear us, but we can't hear you. So please type the questions that you have in the question box, in the chat box. Please make them succinct so we can, our host can read them and get back to you with the relevant information. So without further ado, I'd like to introduce Sandy McEachern, who's going to be taking us through tonight's webinar. Sandy is a director and consultant at Holmes Sackett in Wagga Wagga. Holmes Sackett manages a farm benchmarking database that records production and financial performances of over 180 businesses from across southeastern Australia. Holmes Sackett provides a unique service that combines benchmarking data, farm economics and finance with the science or production systems to help clients improve their profitability and to grow their farm businesses. So Sandy, are you available to start now?
I am, Hilary.
I'll just switch over to you.
Okay.
Be right to go.
So can you see my screen, Hilary?
Yes.
All right. Good evening, everyone. Thank you for attending. So as Hilary pointed out, the purpose of this webinar tonight is just to give an update on the latest full year of benchmarks for the beef and lamb enterprises that we benchmark. I have got some preliminary data for the 2019 benchmark year, but we have to be very careful with that at this point because we don't have a lot of data in, and so those numbers could change substantially from where the averages I show you are tonight. I think the last time I gave an update on these benchmarks was in 2017, and that was for lamb only. So we've got an extra year of a full year of production data to add to that. And so I'll look at a few of the trends over time and a few of the individual KPIs, and at the end of the talk I will put up some slides that have a lot more of the KPIs on them, and the reason I've put them in the slideshow isn't necessarily to talk to them tonight, but it is so that if you want to go back and refer to them, you'll be able to find them in this webinar hosted on the MLA website. So I can talk to any of them if we need to, and if you've got questions about them, I'm happy to, but they're there mainly so if you need something at a later date, you've got a reference point to go to. So just Hilary said, we benchmark around 180 farms a year, and the little red dots on this slide are basically where the benchmarking data comes from. So they're all the postcodes from which we've got benchmark data, and beef would go across all of those postcodes, lamb would be a little bit more dominated towards the southern and eastern end of those postcodes. So down in the higher rainfall areas is predominantly where the lamb benchmarking data comes from. So we're talking about roughly 100 beef enterprises and 50 lamb enterprises every year. So it's a decent data set to begin with. It is a skewed data set, so when I show you averages of this benchmark data set, it's not the same as if we pull up an ABARE average, which is a random sample of the industry. And that's the case with any benchmark data set. So it is worth keeping that in mind. If you've got a KPI and it says, you know, in the Holmes Sackett benchmarking database, that's average, that you've got to keep in mind that that's usually well above average on an industry basis. It's an average of a skewed sample, which is skewed towards more profitable and productive farms. So these numbers aren't, you know, the average of the industry that I show. And I guess what we're talking about here is trying to think through where our potential is for, you know, getting the most out of the businesses we run. And so we're actually looking for opportunity more so than looking for comparison. So just to kick us off, I've got this slide here, which is the net profit per DSE or the average net profit per DSE from beef enterprises in the blue and prime lamb in the orange from way back in 1998 through to 2018 here, which is a full year. And then, as I mentioned, the preliminary or data starting to come in for 2019. And so you can see through that period of time, if we were to break that graph up into the first half and the second half, you know, prior to 2010, both prime lamb and beef were only averaging sort of $5 or $6 a DSE in profit. Post 2010, where probably over that period of time, it's around $15 a DSE in profit. And now in recent times, our expectations are shifting towards more like $20 a DSE in profit. So there's been a definite trend upwards through that period of time, and most of that upward trend has been driven from the period post 2010. I can't promise it would continue to go up at that rate over that period of time. We don't know what the future will hold, but you know, I do expect nominally profits will rise over time. Whether they rise in real terms is another story. The other thing that comes out of this graph immediately is that the trend lines show that there's actually not a lot of difference between the average prime lamb profit and the average beef profit over time. So the prime lamb has got beef pipped by about $1 a DSE on average over 20 odd years. But in the context of the amount of variation within that data, that is nothing. It would not be a significant difference. So as it is very common from advice from our benchmarking over a long period of time, people ask us what's enterprise's best, and most often the answer has got to be whichever one you do well. You know, and that is because long-term data shows that there's very little differences between enterprises. You'll notice in this the periods where beef has tanked, if you like, where, you know, we're struggling to make any money out of beef. 1998, 2003, which is the spring of 2002, the spring of 2006, which is the 2007 benchmark year, the spring of 2007, which is the 2008 benchmark year. In those early years, whenever we had serious or widespread drought in southern and eastern Australia, you know, it was a good job if you came out of that year with your pants on. Basically, the expectation that you would make money in those years was low. So beef historically has been the most susceptible enterprise to drought years. However, when we look post 2010 and we start to look at 2018, for instance, albeit the fact that not all the database was in drought for the 2017 spring, so some people were well and truly into it, and some people didn't actually move into a serious drought until a bit later. So and really we're talking about last year or what will be the 2019 data. But what's immediately obvious is right now, these drought years aren't causing us to make no money on average. And that's not to say the people in the worst affected areas still won't struggle to make money out of it, but on average, the industry has come out having made what was considered really good profits, 10 years ago, but now is probably considered, well, hopefully a little bit below average profits going forward. So out of that long-term data, it's immediately obvious that beef is very susceptible to drought, and it's probably drought that has caused beef to fall below lamb on average over that period of time. These periods through where we've struggled to make money have held back the average being as good as lamb. Lamb's a little bit the opposite. It's not quite as susceptible to drought as the beef enterprises, and part of the reason for that is because it's dominated towards more safer, if you like, higher rainfall regions, and therefore drought impacts aren't usually for as long and so severely felt. Beef enterprises do push out into more arid zones, more drought susceptible zones. So that's part of the reason. And I think another big part of the reason why lamb isn't as susceptible to drought as beef is because lamb's production period is quite often a lot shorter. So when you think about the time you want a lamb from birth to sale being hopefully 6 or 7 months, as opposed to a steer or a steer calf born, and it might be 16 to 18 months before we've got that animal turned off to the feedlot market, for instance. And so that beef system has a much longer production period, even though you can shut it down and start it up again in different seasons. And I think that's a bit of what makes it more susceptible. And the other part is that it's in a bit more arid zones. So the other thing is beef hasn't had these real price-driven spikes in profit like lamb experienced in 2011, and hopefully, touch wood, lamb might experience again in 2019. So beef hasn't been as available to those price spikes as lamb has over that period of time. So that's the long-term data. More recently, the difference in profit is a bit skewed towards the beef. So in the last 5 years, beef has pipped lamb a bit, and that was because in 16-17, on the back of those beef price rises, the profits were higher than the lamb, even though lamb prices were still good. But beef had that combination of good seasons and good prices. So when we look at what's been going on historically, if you look since 1998 at the annual, and this is just a linear increase, so it's the percentage increase from the 1998 price, or the percentage increase year in, year out from the 1998 costs. If you look at beef, which is on the left, the blue is the percentage annual increase in price that beef has experienced since that period of time. So over that period of time, in a linear line, beef has increased its price by, on average, 8% per annum from the 1998 price. And so that's a pretty reasonable rate of lift in beef prices. But you can also see the orange bar beside it, which says that it's the beef enterprises that we've benchmarked through that period of time have only increased their costs by about 3.5% annually per annum. So what that tells us is that in beef enterprises, the gap between the price and the cost has been widening over time. And that's, I think, a significant part of why in the last few years, beef has managed to pip lamb a few times, even though both have had good seasons and good prices by historical standards. The beef producers have been held cost of production lower while those prices have been rising. For lamb, the annual increase in price has been just over 10% over that period of time. And we talk a lot about how beneficial land prices have been to the industry, and that's not wrong. That's true. But on the flip side of that, we look at the annual increase in costs for prime lamb production through that period of time, and that's been going at close to 13%. And so what's happened over that period of time is that we haven't seen the margin between price and cost widen significantly. It's widened a little bit because the price was higher at the start, so 10% increase on a higher price in absolute terms is a little bit bigger than 13% increase in costs. So it has widened a little bit, but nowhere near to the same extent that beef has. And so one of the issues that's facing the prime lamb industry, and this isn't new, this has been going on for recognised for a few years now, is that the price keeps going up, but our costs in the lamb industry tend to be following it pretty closely. Beef, on the other hand, has seen that gap widen, and I think if we had wool, if we were looking at wool, we'd see the gap would be even wider again. So the disparity between the highest 20% profit and the average in the 2000, and the data I'm showing you here is the 2018 year. That is high as usual, I guess was what we'd say. So this is a common story in benchmarking. If you, in any given year, if you pull out what was the average profit per DSE, and so it's profit per DSE on the left, and just for clarification, when I'm talking about profit, I'm talking about the profit before you've paid any interest or lease costs on, bank debt or lease costs for land. So it's profit before interest. It does account for depreciation on plant equipment, and it does account for owner imputed wages. So everyone in there who's an owner operator gets given a salary as part of it. But we haven't taken out interest and lease costs. So that net profit figure is the profit before interest and lease. So the average in 2018 for lamb was about $18, for beef was about $16 per DSE. And then we look at the highest 20%, or the average of the highest 20% in profit, and in lamb it was about just under $35 a DSE, and in beef $34 a DSE. So there's a significant difference between those two groups, and that's the same in every year. Why does that difference occur? Some of it's luck, some of it's a good season versus a bad season, a timely rain event versus untimely rain event. There's always a part of that, but what we tend to find is that highest 20% do stay up in that highest 20% more or less year in, year out. And if you look at long-term data, you'd probably halve that gap between the highest 20% and the average of everyone. And so it's not, on a long-term basis, the gap between the most profitable and the average isn't quite as big, but it is still significant. And so that is an important opportunity for anyone looking at their own business, is to find out where in that space your business sits over a period of time, and then start looking for what are the things that I could do or change about how I go about my system, my production in any given year, maybe my costs, that might improve my relative profitability to where I am now. And that's the whole purpose of this benchmarking exercise. We're looking for, in any given business, the opportunities to get an extra dollar out of whatever we do for the year. When you break that difference in profit down a bit and look at where the main sources of disparity come from, then you start to see that it's pretty consistent between enterprises. So in this graph here, on the left-hand axis, I've got the percentage difference between average and highest 20% profit. So to explain that, the difference in income between the highest 20% profit and the average is 13.5% difference. That's the top of this blue line here. So there's about 13.5% extra income in the highest 20% over the average. When we looked at beef for the 2017-18 year, there was about 23% extra income per DSE. So that more profitable 20% had more income per DSE. When we go to costs and look at it on a per DSE basis, we can see that they've got about 15% less costs. So the combination of 10% more income and 15% less costs, you can see opens up the margin in what you do quite substantially. So it's a little bit of income, a little bit of cost, creates a much bigger margin. But also, they've got more production, and that's kilograms of beef or lamb per DSE over here on the right. So 10% extra production per DSE. So I've presented this on a per DSE basis because it's the best way to look at these enterprises across different rainfall zones and different climatic regions and different classes of country. If I just did it on a per hectare basis, then the differences might get obscured by how much rainfall they've got or what class of country they are using. Is it river flats versus steep hills? So the kilograms per DSE allows us just to look beyond that. Really, it's about per kilogram or unit of feed eaten by an animal, how much extra production, how much extra income, and how much less cost do they use. So in any year, and this is consistent between years, invariably, you will see the same pattern arise between, and it's consistent between enterprises and consistent between years. The more profitable farms produce 10 or 15% more income per DSE, have 10 or 15% less cost per DSE on 10% more production per DSE. And all of that opens up to profits that in any given year might be double the average. So when we're thinking about our production systems, that's what we're looking for. What's the combination of things I could do that would allow me to do that? I can't be just focused on income, and I can't be just focused on costs, and I can't be just focused on production, because I've got to get all three of these to happen at the same time. And that, you know, is probably the art in what we're trying to do, is we're trying to find something that would work, that would allow all three of those things to happen. The lesser but not unimportant differences, but you know, quite often they're ones that get talked about a lot, are things like price received. You know, so where in those other three we were talking about 10% differences, when we start to look at individual KPIs underneath that, i.e. the price received per kilogram of lamb or the price received per kilogram of beef, what we see is that there's less difference in those single KPIs than what we were seeing in the other ones. So where the other ones we were talking 10% plus, in this case we're talking 5 to 7, 8% difference. So the difference between, in lamb, the difference between the average price for the average was 3% lower than the average of the top 20% or highest 20% in profit. In beef it was a little bit higher, 5%. Average sale weights were 3 to 4% higher for both, and that's in kilograms per head for both lamb and for beef. And the average price received per head, which is really the combination of the price received per kilo and the sale weight, was again 6 to 9% difference in per head differences. So when we look at these individual KPIs, again, you know, they all contribute to income, or they all contribute to costs, or they all contribute to production, but each one on their own becomes a smaller part of the difference overall. So, and again, we're just trying to tease out which one's going to be most important for the individual. And so the individual's got to look at all of their KPIs, not just any one in isolation. And I guess that's the main point of understanding benchmarking numbers and understanding your business, is that you have to be able to view that with all the numbers in front of you and view it in context, and then think about it from a systems point of view. As soon as we get caught chasing individual KPIs, we're going to get caught out with you know, a problem in our business. If we chase just cost of production, we might end up with not enough production. If we chase just price received, we may not get enough production. If we just chase production, we may get too many costs. So it's the balance, the best balance of all of those things that we're looking for. It's really important when you're looking at your data to be able to interpret it. I think you've got to keep it in context of what profit you're already making. So as an example, if I look at the beef in this graph, and I've just pulled up 2 of these graphs out of our benchmarking data. And so one of the things that tends to happen with benchmarking data is we group up the data into the average of everyone and the average of the top 20%. But what that doesn't show is the amount of variation within that. And so if you look at on the beef example here in the bottom right corner, I've got net profit per DSE on the left-hand axis and the price received per head for animals sold on the horizontal axis. So that price received per head sold average varies from about $750 through to about $1,500. If we go and look at $30 net profit per DSE, I can see there that people have made $30 net profit per DSE. If we run our eye across this line here, they've started at $1,200 a head and finished at $1,500 a head. So if I look at my KPI, my benchmark, and it says my average price per head is only $1,200, and I immediately interpret as that's something I need to focus on, then I'll look across and say, well, it needs to be $1,500. But there are people here who've got $1,500 a head who haven't made $20 a DSE profit. So the first thing to do when you're looking at your own individual KPIs is say, where does my profit sit? Because if my profit is really good, I don't think I've got a problem with what I do. So I'm not going to chase necessarily more income per head, heavier weights, for instance. I'm not going to change my system to target heavier weights if I'm consistently making top 20% profits at the target market I've got. I won't worry that animal doesn't get a premium price in the market if I'm consistently getting profits that are in the top 20%. So it helps you to avoid the distractions of what you might or might not do. And let's face it, there's plenty of advice to be had on any of those things. It helps to avoid that distraction if you know where you sit to begin with. If I'm at $10 a DSE profit and I'm thinking about what I need to do, and I look at this data and I say, well, I'm only getting $750 a head for my cattle, then that's clearly not going to be enough to get me to $30 a DSE profit, because there's no one at $750 a head who's making $30 a DSE profit. So that, in that case, it might be that, yes, you need to take those animals onto heavier weights, or you need to get them to heavier weights quicker in order for you to improve your profit, and there's likely to be an opportunity in that. Likewise, if we look at the lamb example, and I look at lambs weaned per ewe joined versus production kilos, and that's measured as kilos per DSE. So the natural assumption is if I increase the lambs weaned per ewe joined, I will immediately achieve a higher kilograms per DSE in production. But if I'm already sitting at 10 kilos of lamb per DSE, we've got people sitting at 100% lambs weaned per ewe joined, right through to 140% lambs weaned per ewe joined. So if going from 100% to 140% doesn't materially increase my kilograms per DSE, then that's probably not a KPI I need to focus on. I should only really focus on it if it's going to take me up the path. If I draw a trend line through that, the trend is that you would increase kilos of beef per DSE with increased lambs weaned per ewe joined. However, the relationship around that trend is not great, and therefore what that tells us is you've got to have a very good understanding of how that's going to happen and how it is going to translate into higher kilograms of beef per DSE. And when are you at your optimum? So if 10 kilos of lamb per DSE is my optimum, and I can get that at 125%, and I'm already there, should I really be focused on chasing 140, 150%? And if I am focused on that, how am I going to work out whether that's actually going to definitely translate into more kilos per DSE? So my point about this slide is it's very important to know where you sit first. When you start to look at these benchmarks, it's important to know where you sit from a profit point of view to help you interpret these benchmarks, because each benchmark on its own below that level of profit is really only a piece in the puzzle to coming up with the complete puzzle for your profit per DSE. So just to finish up quickly, in 2017 I presented these key benchmarks to have highest 20% lamb profits, and again put that in context of what I've just explained to you. But if I had to pick out 4 that I thought in my experience were key to achieving top 20% profits, these would be the 4. It'd be 1 ewe joined per hectare per 100 mil of rainfall. So if I'm in a 600 mil rainfall zone, I want 6 ewes to the hectare. For 700 mil, 7 ewes to the hectare. I want to get 24 kilos of dressed weight of lamb sold per ewe joined. So on the maths on that is something like 120% lambs out of all ewes joined, and an average of 20 kilos carcass weight. The growth rate to sale has got to be reasonable, and so from birth to sale we need at least 280 grams per day. Now that's readily achievable through spring, for instance, but actually that number gets hard to achieve once lambs leave their growing season before they're finished, so over summer, autumn, and it's particularly if they've got to stand still for a period of time before you get the next lot of good feed available to them, a fodder crop or something like that. So that continuous growth path is really important, and I think lambing date is really important in chasing that KPI. And the last one is this roughly $80 per ewe joined in expenses. Now, right now it's very tempting not to worry about your expenses, and I think definitely the market's telling us with the prices that are being offered that it wants more product, and perhaps expenses are a bit less important than they have been in the past. But it's good discipline, I guess, never to lose sight of your expenses, and really $80 per ewe joined is about the mark for what you can spend. And I've broken that up to the right there, that $80, what does it consist of? $22 in labour and labour-related costs, $14 in pasture costs, fertiliser, lime, chemicals, $7 in animal health, $9 per ewe joined in shearing and crutching, $10 per ewe in selling costs, and $15 per ewe joined for all other costs. So that just provides you a bit of a breakdown of where that $80 is going to come from. For the beef, and I tried to organise this in the same way I did for the lamb, it translates to about 0.1 PTIC cow per hectare per 100 mils of rain. So instead of 1 ewe joined per hectare per 100 mil, it's 0.1 of a PTIC cow per hectare per 100 mil of rainfall. It's about 450 kilograms of live weight sold per animal. So that's cows, bulls, steers, heifers, across all your sales, what is the average? And so we don't want to get caught selling steers that have really good weights, 460 kilos, but somewhere in the system when we sell our cows, they're going out at 400 kilos, really skinny because we haven't looked after them before sale. So or if we're selling really light little calves at 280 kilos, how do we get our average up to 450 across the lot? So that KPI is really about making you think about the system and what weight every animal you sell will go at, not just one class of animal. It's like for lamb, growth rate to sale is really important, and particularly on young stock. It appears that about 850 grams per day average is about what you need to get your kilos per DSE up to that sort of 20 kilos per DSE optimum. So that's an important benchmark. And then we've got about $500 per PTIC cow in expenses that we can use. And that $500 per PTIC cow comes from 150 in labour and labour-related costs, 150 in pasture and feed costs, supplements, whatever you've got to give them, $35 in animal health, 35 in selling costs, and about 130 for others. So these were the KPIs, which I'm not going to go through, but are there for your reference. If you get this webinar off the MLA website, you'll have them if you need to, if you want to reference them at any time. So they're the ones for lamb that I've provided, and I've got the same for beef. So just from tonight, the key messages that have really come out from this, quick analysis of the data, both long-term and 17-18, is that quite fortunately, it appears profits are going to stay on average high by historical standards in the face of this drought, and that's mainly because, or in part because, not everyone's been in the worst of the drought at the same time, and the people in the southern part of the benchmarking database have been a bit protected from the worst of the drought. But it's also because the prices are so good and animals have been worth feeding and that sort of thing. So we haven't seen that real collapse in price over an extended period of time, even though it got a bit nasty earlier in this year. Beef has done well to increase profits, even with lower increases in price over time. And I think that is something we should take out of it for every industry, is that how do we stop our prices climbing as fast or faster than the prices climb over time? And so that's a challenge for the lamb industry, and something that the industry, I think, needs to think about. There's always a substantial difference between the highest profit and the average, but the keys to bridging that gap tend to remain the same. A little bit extra income, a little bit less cost, and a little bit more production. How can I put a system together that will deliver me all of those things? And so to tease that out, it's really important that you know your relative profit of your system to start with, because that helps you determine which of those KPIs that contribute to up to that profit are going to be the most important things for you to identify and look at. So that's all the presentation. Thanks, Hilary. Is there questions?
Yeah, there certainly is, Sandy. Thank you very much for that. It was great insight into the benchmarking data, not just beef and lamb relative to each other, but how in each category the average and top 20% performed, and what the participants tonight can really take away from that information. So thank you. Just to give you a bit of a break, those who do have to leave now, can you please take some time to complete the post-webinar survey, which will pop up when you exit the webinar. These surveys are shared with MLA and the presenters, and they really help to improve extension efforts and making sure that we're hitting the right notes with what you guys are wanting out of the industry, and also the presenting efforts, so helping us deliver more succinct information to you guys. So I'll just get started on some of the questions. You did answer this one, Sandy, but if you wanted to just reiterate it, Joe would like to know what the definition of profit is. So if you could just run through that again, just in case Joe missed it.
Yeah, okay. So the profit that I referred to there is the profit before interest and lease costs. So it's your income less or operating costs, depreciation, and an imputed owner-operator salary, which we impute to people who run owner-operator businesses based on our salary survey data of managers, station hands, etc. So that's the definition of profit that we're using.
So the next two questions sort of relate to each other. They're from Steve and Matt. Steve wants to know what's driving the increased cost of production for lamb, and Matt would like to know, has the biggest cost for lamb been labour?
I'll start with Matt first. Yes, the biggest cost in lamb is labour. That's when you add up the labour, and particularly when I say labour, it's labour and labour-related costs. So it's the vehicles, the fuel, the labour, R&M on vehicles, etc. It's the total package of that. That is always the single largest cost. I'm not sure that we could blame the rise in cost in production on labour alone. Wool flocks, for instance, have really struggled to find any significant gains in labour efficiency over the last 20 years. 20 years ago we were saying 7,500 DSE per labour unit, inclusive of shearing and crutching, or shearers and crutchers, was about the mark. and we're still saying that 20 years later. In beef, we've moved from 10,000 DSE per labour unit to 20,000 DSE per labour unit, and now we've got people chasing or pushing towards 30,000 DSE per labour unit. And so one of the things that has helped beef hold their cost of production low significantly has been more and more farms with scale achieving significantly higher labour efficiencies in their business. Prime lamb has achieved some labour efficiency. I think we've moved from about 7,500 DSEs per labour unit to a target of 9,000 to 10,000 DSEs per labour unit. So it's not labour that's holding them back. My theory on it is that the industry's been very focused for a long time on individual traits, be it lambing percentage, be it fat or things, and that's not to say didn't need attention, but the industry probably hasn't been focused enough on the cost structure and what it costs to get that production over time. And I think it's probably in part because it's always had this luxury of a pretty fast accelerating price, and that might be to do with the work that was done, on the markets for lamb and the expansion of demand, into the US, etc. So I suspect it's, as much as anything, it's maybe just a lack of focus. We haven't needed to focus on it, whereas if you were a wool producer or a lamb producer over that period of time, particularly through the 2000s, then you had to be focused on it because prices weren't moving. If anything, they might have been retreating, and if you weren't focused on your costs, you weren't able to drive any more margin out of the business, whereas lamb prices were going up, so a little less focus on costs and a little bit more focus on production.
Thanks, Sandy. While we're just going through these, could you flick your screen back to the lamb KPIs? A few people are asking. If you could, thank you.
That screen?
Yeah, that's it. Thank you. Just one from Michael here. Do you think it would be a fair assumption that beef profitability could take a hit on your trend line for the last 12 months versus lamb? It's difficult to see how beef can sustain the numbers this past year versus 2017 due to the high cost of feed and lower prices, etc. Thank you.
Yeah, it was a surprise to me when I looked at our preliminary data so far, and to be honest, I'm upfront about that. There's not enough data there to say that the 2019 data is going to be as good as it looks to start with. It can shift dramatically, but I think one of the things that's holding it up is the fact that, for instance, I think the central west or north of, say, Wagga, for instance, were in drought. So places north of Wagga were in drought back in 2000 and a failed 2017 spring, which is in the 2018 data, and through that period of time. But at that period of time, we had quite low feed costs. Grain closer to $200 a tonne than $400 a tonne, and so whilst it was dry, the cost of feed was low, and that helped. And then probably back to the start of 2018 or mid 2018, when it didn't break and we got that dramatic rise in grain prices, some areas were lucky enough to get enough rain to get by, and it was probably the timeliness of the rain more than anything. And again, particularly south, where they got enough relief that perhaps the total feed costs weren't going to swamp the average of everyone for the year. So it's hard to say exactly how low it'll go, but I think the early indications are it's not going to sink back to everyone not making any money, or the average not making any money. I think some people would have snuck through last year quite well, just because they were lucky with the timing of rainfall events, etc.
All right. Do you have those beef KPIs there too? There's a few people asking for them.
I do.
Those ones, yep. There we go, pleasing the crowd. So the next question or statement from Chris, which as it reads might be that Chris is a bit confused with the 17-18 data versus the following year, the 18-19 data, but I'll read it anyway. Surely profits per DC and other financial figures in the tables for this year are significantly overstated, i.e. despite high stock prices, very much below average due to the current extensive dry periods feeding costs, ? That
Yeah, I understand why you'd think that, and to be honest, as I just explained, I was thinking, and then I'm still expecting that 2019, which is 2018 through to the end of this financial year, 2019, I am expecting, or was expecting it to be dramatically lower, but the data is what the data is, and I don't think it's being overstated in any way, shape or form. I just think it's probably the fact that, you know, generally speaking, there was a lot of media attention on drought, but there were significant proportions of people, beef producers and lamb producers, who were not as severely affected as some who were the most severely affected, you know, northern New South Wales, parts of Queensland, for instance. And you've got to remember that if you look back here where our data comes from, you know, it's not representative of all beef. You know, when you look at that, you draw a line from Brisbane down to Adelaide, you know, it's pretty much south of that, and a lot of it hugs, you know, more higher rainfall areas and down into Tasmania. So the data where this is coming from in some way probably has protected it from the worst of the drought as well. So it's a combination of, you know, where the data comes from, and the fact that prices were good, and for you know, the early part at least, the feed costs weren't as high as they have been in historical droughts, even though that changed towards the end.
Thanks, Sandy. Stuart would just say, great presentation. Thank you, Sandy. Do you have any comments on beef trading enterprises? And I suppose you can chuck lamb in there as well if you want to.
Yeah, so beef trading and lamb trading in our database historically generates higher profit per DSE, and there's a couple of reasons for that. One is it's opportunistic, so I can opt in and opt out of when I trade, so I only trade when I see a significant opportunity in the market. That's part of the reason it gets higher profits, and the other one is because these profits are calculated on an average annual DSE basis. If they're only there for half the year, but they make a profit, well, on an average annual DSE basis, it doubles the profit per DSE. So that's just the maths of what we do. So I deliberately don't put it in here as a core enterprise because in my experience, having seen people go all trading, they struggle to maintain profits that are significantly different from breeding. But however, if you use it opportunistically, it definitely adds significant value to the business. So I would stick to the recommendation that trading sheep or trading cattle is done opportunistically when you can opt in and out of the market, but you might as well have a core business of breeding as your core business, because that's going to be as good as, like, if you go too large a scale in trading and that's all you do, then invariably those profits end up just being where you were breeding anyway.
Thanks. Yeah, so Stuart's next question was on the flexibility versus breeding and trading mix, so I think that was well answered there. Shane would like to know a bit of a technical question. Does the 1 sheep per 100 mil of rain differ between breeds? For example, could a composite be 0.8 of a sheep per 100 mil as opposed to 1 per 100 mil of a merino?
Yeah, well, I'm specifically only talking to crossbred sheep there. I'm not including merinos in that calculation. So I'm only talking about first cross ewes, composite ewes, specialist prime lamb producing ewes. So if it was merino ewes, I'd expect a few more.
Thanks. So Edith would like to know, what are some key KPIs to initially assess to get started with for someone new into a mixed lamb and beef enterprise?
Yeah, well, I think some key KPIs would be your average annual DSE that you run and perhaps break that back down to a per hectare basis. So being able to calculate your DSE rating for the year for the stock you run, I think is important, because in any of these analyses, we see that making sure your stocking rates are at their optimum is important, and that's really comes back to making sure we eat all the grass we grow to the best of our ability. So I would always start with being able to calculate how many DSE I actually run over the course of a year, and then I can break down income, expenses, profit per DSE, and then I can compare across my district to other districts, across my enterprise to other enterprises. So understanding how many DSE you run in each enterprise and for the whole business across the year, I think is really important. And then the next one I think that would be important to calculate is the production. So how much do I actually produce for the year? And whenever I talk or throw up production figures in these KPIs, I'm talking about the difference between closing and opening inventory. So the calculation is the total kilos of cattle at closing minus the total kilos of cattle at opening, plus the kilos sold less the kilos purchased. So it'll look somewhat like the kilos sold, but it'll be adjusted according to change in inventory, which is the closing minus the opening, and how much I've purchased. And so if you follow that methodology, you'll get a production figure that's consistent with KPIs you'll pick up out of the industry. And if you can calculate that for whatever you produce, then you get a very good idea of where you sit in production terms relative to everyone else. And I think they're the two I would start with if I was looking at it.
Yeah, thanks, Andy. Michael would like to know, when you refer to your top-end clients chasing 30,000 DSE per labour unit, would those businesses be highly reliant on contract labour for fencing, spraying, etc., allowing them to stay on top of the day-to-day jobs?
So we ask people to put in all days of labour that appear on farm. So if you hire contractors, we actually ask how many days of labour did those contractors provide. So it's not just owner labour, it's every person that worked on farm over the course of the year. That's how we calculate that DSEs per labour unit. So if contractors were substantially more efficient, then maybe they would contribute. But largely, those beef businesses don't have a lot of contract labour in them. They have contract jobs done, i.e. fencing, or maybe spreading fertiliser, things like that. But it's not. No, they're not usually significantly driven by contract labour. The real driver, I think, has been scale, and it's a bit like the cropping industry. They worked out that if we buy another farm and we just tear up the fences and crop it wall to wall, if we upscale our gear, we can probably do it with the same amount of labour. We just cover more hectares in any given hour. And it's a bit like that for beef, I think. People have worked out if they buy another farm and add more cows and keep it simple, then there's not a lot of extra labour in maintaining the fencing for the year or whatever else it is. And the jobs we do with the beef herd aren't, there's not a lot of day-to-day activity actually with the cattle themselves. So I think it's been driven largely by increases in scale.
Yeah, I think that leads into our next question too. Do you have any more detail on how the top 20% are reducing their cost of production? So what things are they cutting out while still increasing production?
Yeah, so let's, just to be clear, we're not actually seeing them decrease their cost of production as a rule. So everyone's cost of production is going up, just like everyone's price is going up. It's just that the rate they're going up is being held at a lower rate for beef than it is for, say, lamb. And I think the main contributor to that for beef over that period of time has been labour efficiency. So labour being the single biggest cost in any enterprise, if I can increase that labour efficiency dramatically, then obviously I'm going to have a significant impact on my cost of production. Quite interestingly, lamb production per hectare, I haven't got the graph here unfortunately in these slides, but lamb production per hectare has been relatively flat, as has beef production per hectare. But they are trending up, but not at a fast rate. So it is really, I think, for beef has been their ability to reduce costs mainly through labour, and then for lamb, they haven't managed to do that to the same extent, not managing to increase production. Basically, costs are going up with the CPI increase or the wage inflation costs or the your vehicle costs. As they go up, the costs go up. Plus, I think a bit of extra money being spent on things that aren't necessarily delivering more production. So, yeah, I think it's a combination of all of those things that explains the difference.
Yeah. So there's only a few more left. If people want to get their questions in, you do it sooner rather than later. Steve would like to know, is there any further comment on midwinter stocking rate KPI related to the spring lambing in their data?
Yeah. Interestingly, we don't see a lot of difference. So if we're talking about the prime lamb, I assume there, and we look at the midwinter stocking rate, we've got 13 for the average and 12 for the highest 20%. So not a lot of difference in midwinter stocking rate. If we went back 15 years ago, we used to talk a lot about the midwinter as a key KPI, and largely that was driven out of sheep or wool and beef, a focus on wool and beef, where to keep pasture utilisation up, and knowing that we grow most of our grass in the spring, if we could run more heads in absolute terms through the winter, which was considered to be a bottleneck in southern and eastern Australia, and then let those heads reproduce or grow, in terms of growth rates through the spring, we would get better utilisation of our pastures and we would be able to make more profit. And that, for wool enterprises and beef enterprises, that still holds true. However, for prime lamb, we've got this conundrum in that if I do that in prime lamb, I hit the end of spring and into summer, and I either have to sell a lot of little lambs or I have to hold them for a very long time through the summer and autumn to try and finish them, or I have to grow more expensive crops. Unlike beef, I don't have the luxury of running them around for 12 months and doing it and then letting them get that weight gain in the last of that weight gain in the second spring. So in prime lamb production enterprises, I don't think your winter stocking rate being lower than your average annual is such a big deal. In fact, I'm inclined to say your winter should be your peak stocking rate for the year so that you can get those lambs off in the spring.
Yeah, that's interesting. So Ryan, I guess, follows on with that. Is there any profitability difference between spring lambing selling store lambs compared to autumn lambing selling export finished lambs? That's with a higher stocking rate with spring lambing.
Yeah, well, you get spring lambing selling store lambs is still a bit of a problem because most people who buy store lambs like to think that they'd buy them at 35 kilos, and anything less than that is too small. And so to get a lamb to 35 kilos with a spring lambing system is actually quite difficult. If I'm in southern Australia, high rainfall, and I want a lamb in spring, say, let's say September, most of those areas still have faced pasture senescence, at the latest in late December. So I've only got September, October, November, December, 4 months to get that lamb from birth to at least 35 kilos and then sold. It's quite a difficult task, and so people tend to try and lamb a little bit earlier, which ends up being in the winter anyway. So that system, I think, is more difficult to get top 20% profitability with, is a store lamb system, and it's inherently pretty volatile as well. You're selling those lambs into a pretty volatile market over summer when, whether you get a good price or not for them is very dependent on grain prices and how tough the seasonal conditions were. The autumn lambing system, again, maybe a little bit too early in my opinion, in that they're great if you get the autumn break on time and you've got green feed to lamb onto, and everything's very rosy under those conditions. But where we get a average or later than average autumn break, there's a lot of supplementary, to hold your ewe numbers up, there's a lot of supplementary feed that's got to go into the system to do that. And again, that becomes expensive. I personally think the sweet spot is in between there, a winter lambing, midwinter probably, lambing, and get those lambs off domestic trade weights before Christmas, really. That's where I think the sweet spot is.
Yeah, okay, you're generating a bit more discussion here, Sandy. How about the difference between profitability between autumn and spring drop cattle herds for high rainfall zone?
Yeah, look, I'm going to preface this with what I'm talking about here is what I think it's easiest to make your money doing. And so I would definitely say I think it's easier to make that top 20% level of profit out of a spring drop calf with turning that off to the feedlot market. That gives me, I think, that optimum mix in your herd structure between adult cattle and young growing stock. So if I go to weaner systems, I've got a lot of adult cattle for every kilo. I've got a lot of adult beef sales for every kilo of calf I sell. And so changing your target market to the feedlot market and the spring calving, I think changes that herd structure mix a bit. It's a pretty easy system to implement. There are people who get autumn calving systems to work really well, and I take my hat off to them to be able to keep your stocking rate up, to keep your production up, to be able to drive that system as well as it needs to be driven to make those sort of profits is, I think, excellent management. Whereas I think if you do it in a spring calving system, you can do it a lot easier. And another thing is I think we've seen a lot of our expansion happen with herds in spring calving systems because they are easier to manage. So they're a lot less intensive, which means expansion's a lot easier. I haven't seen many autumn calving systems expand dramatically over this last 15, 20 years. And I think in part that's because the system is hard to implement when it gets to a large scale.
Thanks, Sandy. Do you see a correlation between supplementary feeding and profitability? That's from Stuart.
I think, from 2000 to 2010, every time we brought out the feed cart, we thought we were losing money. Whereas post 2010 and really post 2015, when these prices for beef really took off, I'm starting to think we're probably the people who won't supplementary feed enough are the ones missing out. And I think the market's really telling us to push up production at these prices. And I think we've got to be prepared. If we really want to optimise the opportunity, we've got to be prepared to supplement maybe more than we have in the past, and maybe use things like urea, the gibberellic acid, the cheaper forms of supplement when the growing season's on, to a larger extent, and maybe even grain and hay around the edges as well to drive up that stocking rate a little bit. So I think the market's definitely telling us to push production, and we've got to train ourselves and respond to that and be prepared to feed more perhaps now than we have in the past.
Okay, great. Just to finish it off, seems a bit cheeky, but there is a few questions if you have any comments on how the wool KPIs compared to the beef and lamb from that benchmarking period, if you just want to touch on that briefly.
I think that is cheeky. We have never, in my time in previous 19 years of reporting benchmark data, I've always been able to say that the top 20% of any enterprise is better than the average of any other. And in the 2018 data, you couldn't say that about wool. Their average profit per DSE out of wool flocks was better than the top 20% of both beef and prime lamb. That's the first time that's happened in 20 years. So wool is having an extraordinary time at the moment, given where the wool prices have been driven to, helped by sheep meat prices as well. But yeah, certainly that they are in a league. Wool is in a league of its own, right at the present at these current wool prices.
Thanks, Sandy. Just the last one now from Michael. Could you just quickly run through the conclusion, the key messages on that last slide that you had? Just run through them again just quickly and then we'll wrap it up.
Righto. So my key messages were that, and I think this is probably the surprising one, and I can tell by the questions that people are surprised, is that profits from lamb and beef have remained high by historical standards in the face of this drought. And the reason I think that's important is I think that we've got to have an objective view. If we just listened to what's, the tough stories, and I don't doubt there are a lot of tough stories out there and a lot of people have really struggled in the worst of it, in the worst hit areas, and the people that have been hit the longest. But there's a whole, subset of the industry around there. There's, I think, $2.2 billion worth of assets under management in this database, and it's only a sample of that southern and eastern agriculture where that hasn't been as affected as badly, and that are actually done quite well out of that. And I guess if you're lucky enough to be in that position, it's believing that times are good and chasing these good times, despite all the negative that we're hearing about, that it's not as good as it is. It is really good. So being focused on that as an opportunity, I think, is really important. I think there's a lesson for us in looking back through time. If we compare lamb and beef, and how beef has managed to hold that cost of production, not decrease it, but hold it lower over time, then the price has increased. And thinking about your system and what can be done in that system, whilst prices are increasing, it's less important probably, but it's still opportunity that you're missing. And so I think never lose sight of that going forward. And in prime lamb, we've got a lot to do in that area in terms of keeping cost of production low. The gap between highest 20% profits and the averages is the same as it always has been. It's in any given year, it's usually double the profit in the highest 20% versus the average. So that's the same, and nothing's changed as to what drives the differences in those gaps. So what made those farms more profitable from 2000 to 2010, when things were a lot tighter, to now, are the same things. The difference is the differences are amplified. We're talking about bigger dollars in that difference. And so, we probably should be more focused on the opportunities now than we were a decade ago, because those opportunities are bigger now. Even though we're all making more money out of what we're doing, the opportunities are bigger now than they were. So we probably should be working harder now than ever.
Okay, thanks, Sandy. There was just one more come through. Quickly, has the dual purpose sheep been historically more profitable than the prime lamb system?
Yes.
Yes.
The answer to that is yes. So, yeah, and to explain that, the dual purpose being people who put a terminal, i.e. Dorset, or maternal, i.e. Border Leicester, over merino ewes. There are the odd dual purpose breed in it, but most of it is merino ewes joined to terminals or maternal sires, and the lamb sold off. It doesn't matter whether they're stores or killed, whatever, but you get the benefit of the wool price for the fleece plus the meat sheep price for the lamb. And yes, that has historically been more profitable.
Okay, excellent. Thank you very much for joining us tonight, Sandy. Thank you everyone else for also tuning in. Please don't forget to fill out the survey as you finish. And yeah, thanks very much, Sandy.
Pleasure.